Good morning and welcome to the B.F. Anderson February 17th Technical Report. The January Barometer, developed by the Hirsch organization, Yale Hirsch, has probably been one of the most remarkable indicators of the stock market annual performance out there. It's got close to a 90% success rate. Now, what the indicator is that if the month of January is up, very simply, the year follows. Now, this hasn't always been the case, but there's a lot of logic that goes into this, and I have a theory. And the theory is that analysts revise their earnings estimates for the calendar year usually in the end of the fourth quarter of the prior year and in the first quarter of the new year. So if the analysts as a group, meaning the S&P 500 or Dow 30 or any of these indexes, if those companies, if the earnings estimates are being revised upward in January, then January is up, and if we have no recession and earnings are good, you have a good year. You know, I really do boil this all down to earnings and interest rates. I know it's important who the president is, and I know it's important what's going on in North Korea and all these things, but I truly believe that once it all gets boiled down, it gets boiled down to corporate earnings. So one of the things I also wanted to talk about today is market corrections, because they're inevitable. And, bear markets are, inevitable. But in the long term, the stock market has gone up. It's been a good deal. And, one thing that's really a reason I like stocks is that you've got liquidity. You can get a price of your asset on an hourly, minute-by-minute basis or daily basis, and you have liquidity. So I think that's a real positive. So anyway, one of the I would say probably the best indicator that I have seen over the years of a market top or a market bottom is having to do with investor sentiment. Now, what I mean by sentiment is everybody out there optimistic and bullish, or is everybody out there pessimistic and bearish? And I have noticed over the years that when, people get real upset about the market and they hate stocks and nobody wants to buy stocks and so forth, that's usually a market bottom. Now, market tops, and if we take the year 2000, which I'm going to show a graph on this in a minute, but if you take the year 2000, our phones rang off the hook. We were getting people that would normally not invest in the stock market calling us up, wanting to get their money out of anything that they had their money in, put second mortgages on their house and everything to get into the stock market at the top. So sentiment is something that's really important to keep an eye on. Now, it is a secondary indicator. It's not a primary indicator, and the primary indicator is the trend. So let's look at the trend here. Now, what I've done is I've got the New York Stock Exchange Composite, which is a very broad index. This is a lot of stocks. It's much more than the Dow 30. So you get I think, a little bit more of a truer picture of things. Now, what I've done is I've removed the volatile price of the index, and all I have here is the 25-day moving average and the 50-day moving average. So this is 2015, and I don't know if you guys remember, but in August of 2015, we had about a 10% market correction. And right around here, sentiment got pretty high, and we put out every Thursday on our market report, we put out an indicator called the Fear Greed Index. And I don't know if you noticed yesterday, but we are in extreme greed. We've got a reading of 80 out of 100. And so just like August of 15, sentiment was very high. People were very positive here. Well, then all of a sudden you see a confirmation of a market top in the beginning of a correction, where the 25 days starts turning down, breaks down below the 50 days, so you get what you call the death cross. The moving average is definitely in a downtrend, and then the 50-day, it too turns down and goes down. So that's what things looked like before correction in August of 2015. So let's look at where we are today. Looks nothing like this. Nothing at all. Both of these moving averages are in uptrends. You've got white space in here. It looks like an uptrend to me. So the problem comes in, I believe, and just let's go back real quick. You can see the downtrend here. This is not anything like what we're seeing right now. Now, we are seeing high levels of sentiment right now where people are kind of getting a little bit optimistic, having to do with the election, whatever. But the big problem comes in, I believe, is the financial media. Fox Business News Network, CNBC, all these mass-produced programs, internet, anything on the internet. This is all human opinion. And I have learned over the years that human opinion most of the time is wrong. And usually the masses are wrong. And so what these people are doing is they're getting on TV and they're saying, we predict something. We predict a correction. We predict a bear market, whatever. They don't know. It's nothing more than a guess. And that's what you got to realize. So what makes more sense to me is to look at what is the market telling us. All right, let's look at another example. I'm going to skip down here real quick. This is the Russell 2000. This was another correction back in, this was actually the beginning of a bear market in 2007. We all remember the 2008 bear market. Again, you're looking fine, everything's going well, then boom, you get the cross below the 50-day, the 25 days going down, both of them going down. Clearly, the market has put in some type of top here and is moving down. So let's look at the Russell today. Now, of all the indexes that I follow, and I follow many of them, the one that is showing the most weakness right now would be the small cap stocks. Now, this is the Russell 2000, again, just the 25-day and the 50-day moving average. And you can see that these two moving averages are starting to kiss. So maybe, if this turns down and so forth, you might want to be kind of careful about getting involved in small cap stocks. Now, let's look at another index. This is the S&P 500 stocks. This year that I'm looking at is 2011. I can remember 2011 well. We had a lot of problems in 2011, but we came out of it in 2012, and then 2013 was one of our best years ever. But again, you can see what's happening. You get the breakdown. Moving averages are turning down. You got a little bit of a rally here, but if you continue to pay attention to that 50-day, it never did turn up. So again, that's how things looked back in 2011. Now here we are today. It looks nothing at all like that. I mean, we've got white space, both moving averages moving up. Now, real quickly, here's what's important to understand. This is the New York Stock Exchange Composite. I go back to 1980, 82 in here. Now realize the market had formed a top at 1,000. Now this line up here is 1,000. Excuse me, I'm sorry, I'm mixing this up with the Dow. The New York Composite was at under 1,000, and it had moved. It had peaked at this very peak back in 1966. So here we are, 1981, and you're still not making new highs. Then all of a sudden, Ronald Reagan comes in, the economy turns up, inflation gets under control, and we start a new bull market that went from, basically broke out in 1983 and continued higher all the way up to the year 2000. Now, this is the top that I was talking about. This is where the masses were coming in. People were day trading. I can remember that. It was just crazy. So the problem with the correction is that, or being worried about a correction is that you could be in the market and we're starting to break out here, just like at this time. I would compare this very much to the 1966 to 1983 period. I mean, if we really kind of look at this is one big box here that has gone for 19 years. So, after 19 years of really not going anywhere, people, you can't give a stock away. People don't like the stock market. But we're starting to break out of actually a 3-year consolidation here. And we're breaking out for one reason only, and I believe it's because fourth quarter earnings are coming in fine, and there's good guidance for 2017. So earnings are looking better, and we've been in a earnings recession for the last 2 to 3 years, and that's why this thing hadn't done anything, is earnings are not going up. But the problem with the correction stuff is that you get going like this here, and you say, okay, the market's gone up too much, there's going to be a correction, so you get out. Well, then it just keeps going. Well, yeah, you're going to have these little blips along the way. That's just going to be normal. You've got to figure out a way to stay in the sitting position, like Livermore says. I made my money in the sitting. So once you get an uptrend established, you don't want to be too anxious to take profits or get out of the market. Now let's look at another individual situation here that is a trend that we see in the economy right now and we're seeing in the stock market. It has to do with the subject of e-commerce. In other words, Amazon.com. This is a graph of Amazon.com. Now look, I've got the moving averages, no price. I'll show you the price in a minute. But there are 43 analysts that follow Amazon, and they're projecting that earnings are going to be up 74% next year, which is 17. Now the chart has somewhat been moving sideways, but the stock really does break out at about $850 a share. Now you can see here that it has been kind of moving sideways. Now you look at the graph, and you know it's got what we call a cup. We got a handle here, breaks out at 850. I think that's a positive trend. What this all boils down to, as we know, is that brick and mortar stores are slowly but surely going out of business. It seems that way, at least. I mean, Sears, JCPenney, Macy's, Kohl's, all these companies are trying to compete with Amazon. They just can't compete because they've got all that overhead. Now, here is a small company. Now, the reason I'm not real big on Amazon is that it's just gotten too big, and I kind of think it's somewhat discovered. But here's a little company called Shopify that we are interested in. Again, it's involved in e-commerce. There's 25 analysts that are projecting growth next year of 64.3%, and the chart is in a really nice uptrend. You can see a lot of white space here, and the stock is acting well. Now let's just look at the price of the stock. They announced earnings 2 days ago, and they beat estimates, and their revenues beat. Stock took off, was up dramatically on the day of the earnings announcement, and it looks like to me this is a very, very powerful uptrend. So in conclusion, what I'm saying here is that don't get hung up on human opinion, especially when it's on TV. Look at the market. Let the market tell you what's going on. And right now, there just doesn't look like there's a correction coming, but that could change tomorrow. But I think you need to be aware of moving averages and go that route. Call me if you have any questions.